Right. So we've got another great panel that's all ready to go. So let me give you some introductions. I'll start by introducing our moderator for the next panel, who's Bob Clark, who's an expert in bank regulation. He works to advise governments and major banks on how to adapt to changing regulation as a senior partner at Bracewell and Giuliani, where he founded their financial services practice. He's also been a bank regulator himself. He was appointed by Ronald Reagan and then reappointed by George Bush as the comptroller of the currency. Now, if that's not a title that's familiar to you, essentially he is the head of the OCC, the Office of the Comptroller of the Currency, which is one of the three major federal bank regulators. So as the comptroller of the currency, Mr. Clark was supervising around 5,000 nationally chartered banks that represent about 2/3 of the assets of the U.S. Financial system. His expertise is not just national, however. Mr. Clark has served as a consultant to the World Bank and a senior advisor to the president of the National Bank of Poland. He was also an advisor to the governments of Hungary, Argentina, Brazil, Mexico, Latvia, Romania, Kazakhstan, and Hong Kong. And perhaps most important to mention is that he's a Rice alum and a Rice University trustee. So we're very happy to have Bob Clark come to join us today. Joining the panel to start with the first presentation is George Chichekos of the Labos School of Business at Drexel University. He's the George B. Francis Professor of Finance. He's also the director of the college's Risk Management Center, and until very recently was the dean of the business school. George has authored books on finance and international capital markets, and his research covers corporate finance, investments, banking, and international finance. He's advised the World Bank, the SEC, Bear Stearns, Fannie Mae, and the Philadelphia Fed. He's been spending some time recently in his native Greece, this spring advising the central bank. Next, we have Mark Wynn, who's joined us today from the Dallas Fed, not the Houston branch, but the honest-to-goodness Dallas Fed in Dallas. No offense. Mark is one of their most senior economists. He's the vice president and the associate director of research. He's the director of the Globalization and Monetary Policy Institute and leads their research program on globalization and its impact on U.S. monetary policy. Wynn also spent time at the European Monetary Institute and the ECB during the formative years of the European Economic and Monetary Union, where he worked on issues related to the strategy of monetary policy under EMU. He still occasionally consults for the ECB and the IMF. He's our Irish representative today, though I don't know how closely he follows the Irish economy. And then the third speaker is Marvin Barth, who's a good friend and an excellent economist. Marvin is currently the senior investment manager at Covariance Capital, which is an asset management company. So he can bring the sharp perspective of capital markets into our discussion. In his career, he's also had significant policy experience, having worked at the Fed and the Bank for International Settlements. I know Marvin from our days at Treasury, where he was the chief economist for international affairs. And as the chief economist, he was advising the secretary on U.S. dollar policy, commodity markets, an array of economic and financial issues in other countries. So with that, I'll hand it over to the next panel. So George, if you'd like to come.
Things are not on the right track for me today, and I don't know why. I mean, as soon as Russell called me and said, would you like to join a panel at the Baker Institute, I said, I'm going to do that. And in my mind, I thought that I would have the opportunity to meet and take a photo. This is important for a former dean. A photo with the secretary, but he left. Oh, okay, that's great. But I was thinking that perhaps I would be in a panel about Greece, to discuss Greece, but apparently I went to another panel that is not as interesting. So this panel and my presentation actually has to do with what's happening in the corporate sector and the expectations in the corporate sector in Europe. My story is really very simple and builds on the previous stories and presentations of the three distinguished speakers that we had in the previous panel. If you notice, everybody talk about the challenges in Europe, but indirectly, a lot of people talk about some asymmetries and lack of balance within Europe. My story, and all of them talk about corporate debt for sure, and household debt, etc. My story has to do with the corporate sector finances in European Union, and even though the topic of sovereign debt has received so much attention, the topic of corporate debt has not received as much attention, but it's coming up. Addressing the issues of debt for corporates, I think, in the European Union will be the next wave of discussions and issues coming up after we resolve the financing, the bank financing structures in Europe. So the outcome of my brief presentation, I need to shorten it because there is a lot of overlap in terms of material with other speakers, is that really in Europe, we have the core countries and the periphery countries, and given the sovereign debt crisis, we have differences in terms of the financing structures and the risk premia between the core and the periphery corporates. As a result, we are developing two kinds of corporate structures now. One is the core structure, the core country structure of firms, and the other is of peripheral firms, where what is happening is the core countries, they build up enough size and have the opportunity to be outside of Europe, competing for capital in the global financial supermarket, where in the periphery, corporates, they tend to be smaller, even though they add too much value to the employment in those peripheral countries, yet because of their environment, perhaps lack of competitiveness, they are exposed to higher financing expenses or lack of opportunities for them to become stronger entities. So this is my brief story, and I think it derives from the fact that institutionally in the European Union, what we have developed excessively a sector which is, has the financial sector, which is completely different than the one that we are aware and familiar in the United States. Because of the sovereign crisis of 2009 onwards, this particular financial sector, given the interfaces between the public and the private debt, has generated some amplification mechanisms that have impacted, I would say, not in a balanced way, all the corporates in the European Union. And the reason for that, once again, is because the financial sector in Europe is really, I won't say that it's unique, but it has some peculiarities. It is primarily bank-based, even though there are capital markets. Most of the corporates in Europe rely on banking. In the banking sector also, it's very important to have a wholesale operations, and interbank funding is abundant. Transactions are always integrated across Europe, which is a good thing in terms of elimination of costs, but at the same time, it generates some systemic issues. And usually banks in the European Union, not usually, always this is the case, they play a very big role in intermediating sovereign debt. Just in parentheses, in contrast, in the United States, banking is very, very important, we know that, but at the same time, we have developed other institutional structures for funding the corporate sector. And this is really an important difference between the European Union and, but the banking sector really, it's similar to the concept of too big to fail, too small to save kind of a thing that we are talking about here in the United States. It's very central. I believe it's very central to the operations and the funding activities in Europe. Because of the crisis from the sovereign to the banks, there were some adverse impacts or effects via three channels. that created some issues in the corporate setting. Via the banking channels, the sovereign debt created, as we know, issues on capital adequacy and reserves for the banking sector. As a result, credit contraction took place, and the corporate lending was reduced, so everybody felt a squeeze. But this indirectly generated increases in the cost of capital, especially for medium-sized firms. A second channel where corporates were impacted was associated with the austerity programs introduced in the periphery, where because of austerity there were some declines in the product demand of various entities that generated issues of non-performing loans that, again, it had a feedback loop on the banking crisis with the not servicing of those loans, and therefore banks, they needed to take write-offs. They didn't, but it was an issue, still is an issue. And finally, because of the deleveraging, the need for deleveraging in the private households as well as the corporates, many companies, to the extent that they were able to do that, given the cost of capital that was increasing, they were unwilling to borrow. And this had limitations on the growth prospects for the countries in which those entities were operating. So what would be the challenges for the corporate sector in the Eurozone as we know them today? First of all is the high corporate leverage, and I will show you some graphs. The credit tightening, which indirectly had generated some issues for smaller, especially smaller companies. A big contraction on the revenues and the profitability of those companies, especially, once again, on the periphery, not so much on the core. And indirectly, a bigger issue in the entire Eurozone is the global competitiveness of the sector, of the big sector. So the corporate debt, if you notice, based on some statistics, I think it was presented earlier from IMF, this information comes from estimates. It shows really how much the debt over a 10-year horizon has increased. If you annualize that over a period of time, this is a huge increase in some countries. I don't show here Greece, or I don't want to present it because you're going to be scared, and because also the data might be unreliable, by the way. But you can see Spain and Portugal, they have great exposures in terms of the stock of debt. And the percentage of debt as debt as the debt as a percent of GDP really is a very large number compared to the core countries: Germany, Italy, perhaps UK, and France. But what we know matters in Europe is size, because those four challenges that I outlined before, they might impact differently large firms that tend to be in the core compared to the small firms. For example, if there is a lot of corporate leverage, large firms might have the flexibility to deleverage without impacting so much value. They can do that by not paying a dividend, for a couple of years, by utilizing some of their reserves, by rearranging their capital structure with a lower interest rates, depending upon their opportunities that they have in the global financial markets. Whereas for small firms, a high corporate leverage means kiss of death almost, because if you're not in a position to pay off the liabilities, then you're forced to liquidation. In case where there is a credit contraction for the large firms, the only thing that might impact them is the long-term financing, whereas the short-term financing really can be addressed given the credit rating that they have and the ability to finance for the banking sector, whereas in the small firms, the short term is very uncertain, given that the cost of capital and the availability of credit for working capital requirements, which is absolutely necessary for the short term, it might not be there. The declines in revenues and profits Large firms can restructure, they can sell off assets, they can spin off assets, they can do many other things, whereas for small firms, this is bankruptcy, more or less. And in the global environment, for competitiveness, they can make some arrangements, joint ventures, other things, to become more competitive or to adjust to the competitive global setting, whereas for the small firms, a reorganization might be uncertain. So you can see here the size impacts differently large and small firms. And the truth of the matter is that most of the firms in the periphery are small firms. Almost 85%, many firms in the periphery that are small firms also generate a lot of economic benefits to those countries. And small firms create almost 85% of new jobs overall in the in the Eurozone, where large firms only create 10%. And if you take a look on some statistics, some information, and if you segment countries in core and periphery countries, you will find out that small firms, they command approximately 74% in the periphery compared to 64% in terms of the share of employment. So they add much more value to the periphery as opposed to small firms in the core. So this difference is really as a result of the crisis, as the crisis has impacted the financing of those small firms, they have unbalanced impact on the periphery versus the core. And the reason for that is because the crisis has impacted mostly the small firms in a disastrous way and can be contained by large firms. And the access to corporate financing, as I mentioned earlier, it's different across different Eurozone members. This graph shows the banking, the borrowing, the lending rate costs of the periphery versus core countries. To your left, you can see the changes in the interest rates, and this is very characteristic that has happened. This is over a period of time from 2010 to the third quarter of 13. And what it shows is that for the core country, the blue area, for corporate loans, the change in the interest rate has declined on average by 60 basis points, whereas for the periphery, it has increased on a positive side by 40 to 60 points. So it shows that it becomes more expensive to borrow funds in the periphery compared to the core. The bank lending on the right side, was a graph that also was reported earlier. The bank corporate lending changes between the same period of time really have increased, if you wish. Look on Germany. There is, on an annual basis, on a monthly adjusted basis, you can see that in the red line, always there is an increase in the credit availability for borrowing by firms in the core. Whereas if you look in other areas, Spain or Italy, there is a decline. And of course, where is this? Greece is not here, thank God. But in the broad area, the Euro area, there is a decline in the availability on a percentage basis on the availability of lending by banks that are in the core. And why banks they cannot really lend is because in the periphery, what has happened is all the deposits are gone. This shows what had happened in Greece in May 2010, for example, or Ireland in October 2010, in the month 0, where the deposits, let's assume there were $100, within 18 months in Ireland, almost 20% of the deposits evaporated. In Greece, it took only a year for the deposits to be shifted where? not to the United States, but to their core countries, especially Germany. So it's, this is a convoluted kind of an issue that has resulted to accumulation of more capital and investment flows, actually. This is the investment flows that have moved from the periphery to the center. The blue line indicates the investment flows in the euro area cumulatively over a period of time and as a percentage of GDP. They have increased. This is the percentages. They have increased over this period of time from January 10, the data that I have is until January or so of 12. Whereas in the periphery, there is outflow of investments to the core. And this shows, again, the differences in the spreads or the lending rates, if you wish, in the corporates, which is the blue line, vis-a-vis the baseline kind of a rate, which is for the German core rates. So my story really is very, it drives from what we know from the difficulties in the European Union. And the difficulties are associated with a banking sector. The next wave of challenges will be what do we do with the corporate sector? And for us to assess better the corporate sector, we need to be looking very carefully on two aspects of the health of that particular sector. One is the debt sustainability, which is the debt to EBITDA, and the second is the ability of companies to maintain or to service the interest exposures that they have, the interest coverage ratio, that is so important. So what does it show here? For example, the leverage, which is the debt to EBITDA. The red shows the periphery. The periphery really has much more leverage compared to the blue line, which is the core countries. And the coverage, again, it's better for the core countries compared to the periphery countries. So, remaining concerns, the capital flight cannot be addressed right now with the structural issues that they have in Europe. The private capital has been replaced in the periphery, especially by public sector flows. Huge funding asymmetries, as I indicated earlier, between the core and the periphery. So liquidity issues in the periphery that cannot be addressed immediately unless there is a high expense, which is the premium attached to the sovereign issues in those countries. So what is the way out of it? There's just what we discussed before. If we do a bank reform in Europe, if Europeans get together and decide to introduce the institutional structures required for all these impediments to be eliminated, deposit insurance, for example, then we might see perhaps a plain level field for the corporates in the Eurozone. Is it possible? I don't know. I'm not very optimistic on that, but I can assure you year after year or month after month, what is happening is that in the corporate sector, we tend to have two Europes. We have those that they operate with a high cost of capital and perhaps with a high labor expenses because of institutional rigidities of the past, and in companies that they have, they add a lot to the employment opportunities for those peripheral countries, but they don't have the ability or the ability to really compete effectively with other European corporates, core European corporate firms. So in that scenario, what do you anticipate? An arbitrage opportunity that is for the core firms to take over via mergers or acquisitions, firms that will be very vulnerable in the periphery and therefore consolidating more market power and perhaps generating a better industrial base for the European Union as a whole, for the Union to be much more competitive in the global setting. This is my prediction. However, nobody knows because right now the business activity in the periphery countries lacks the institutional structure needed to do really good quality business. So I wish I had a better prediction to present, but the way that the corporate sector operates in Europe right now is a reflection of the difficulties that are associated with the architecture of the European Union and the design of the European Union that has impacted the banking sector, which is then has impacted the financing opportunities for those corporates. And with this, I hope Greece will be able to survive, but I'm not hopeful. Thank you.
So at this point, I don't know if there's anything new left to say about the Euro crisis. It's been going on for 5 years. What I'm going to do is just try to help you understand some of the issues confronting Europe by drawing parallels between the economic and monetary union in Western Europe and the monetary union that exists in the United States between the 50 states of the US or the North and South or the East and West or the blue states and the red states. There's a lot of parallels we can draw between European developments and US developments at the international level that shed light on the Euro crisis. According to the internet, that picture is a picture of Cortez burning his ships when he arrived in Mexico. Many of you may be familiar with this legend that when Cortez arrived to begin his expedition of conquest, in order to motivate his companions, he burned the ships so that they knew there was no going back. They'd made an irreversible commitment. And in many ways, you can think about the launch of monetary union in Western Europe among the Euro states as a similar irreversible commitment that will force them to confront issues they have avoided for many years. I'm going to skip this. This is a quick chronology of the Euro crisis that began in the spring of 2010 that culminated in bailouts for Greece and Ireland. 2011, we had Portuguese bailout, second Greek bailout. The fiscal compact was agreed, which is a fundamental change, arguably, in the architecture of the monetary union. And the ECB began its long-term refinancing operations to sort of stanch the losses in the banking sector. 2012, we had the Greek default, a bailout of Spanish banks. The famous commitment on the part of President Draghi to do whatever it takes to save the euro, which was then operationalized with these outright monetary transactions, which have so far not yet been conducted. And it remains to be seen, actually, if his bluff is called on these things, how well that program will work, and what will happen to the incentives of countries to undertake difficult structural reforms once they've gotten into one of these programs. Importantly, the European Union won the Nobel Peace Prize last year. I say this slightly in jest, but slightly to remind you of a comment that Robert Zoellick made in his remarks opening this conference. This is the 68th year of peace in Western Europe, and it's a major achievement. After the horrors of the first half of the 20th century, the Germans and the French, the Germans in particular, are willing to go a very, very long way to prevent a recurrence of what happened in the first half of the 20th century. It doesn't mean they're willing to pay any price, but they're willing to pay a lot to prevent that happening again. And compared to the expense, the loss of human and physical capital that took place between 1914 and 1945, the costs of the current programs are relatively small in comparison. This year, the fiscal compact entered into force, and I think we're currently going through the first European semester where national budgets are being reviewed by the European Commission before they're being presented to the national parliaments. That is a major change, and that you've got to think that begins to grate at some issues having to do with national sovereignty. And then, of course, we had the Cyprus bailout in the spring of this year. Now, here's this picture that has been presented I think already at least once or twice, I think it's a great summary of what has happened over the past 25 years in Europe. You see that prior to the launch of the euro in 1999, financial markets viewed the debt of different sovereigns very differently. Greece paying the highest interest rates, Germany being the best credit. These rates all converged in the run-up to euro, mainly because they had to converge as part of the criteria for joining the single currency in 1999, so that by January 1st of 1999, there was essentially no difference between the rates paid by the first 11 members. Greece still had higher interest rates, so they didn't get to join the first time around, but 2 years later they did. Now, the reason these differences existed was that these countries presented different risks, not so much default risk as inflation risk. The way you got out of trouble in the past in Europe, if you're a European sovereign government, was to inflate your way out of trouble. This is the way they dealt with their problems. Once you join monetary union, that's no longer an option. So after monetary union is launched, the interest rates all converge to essentially the same German level. There's like maybe basis points differences until the crisis hits in 2007, 2008, and then they blow out again to an even greater differences than existed prior to the launch of the euro. Now here, it's not because of differential inflation risks. This is the risk of actually crashing out of the single currency and defaulting outright on your debt. When you can't inflate away the value of the debt, the only other thing you can do, if you're not willing to raise taxes and cut spending, is to simply default on it. And Greece has already done this. And there's the risk then that some other countries may do. Now, this is the worst period of the crisis. There's been some convergence, but we're nowhere near back to the levels we saw prior to the onset of the crisis. What if we look at some US states? So here I just showed a selection of the biggest states in the US. And you see there's essentially no difference in the interest rates the different states in the US are paying, as you would expect to see under a monetary union, because these guys don't get to conduct their own monetary policies. They've got to live with the monetary policy set by the Fed until the onset of the financial crisis. And now financial markets are differentiating and distinguishing between the debts issued by the different states within the United States because of the risk of default, largely due to unfunded pension obligations. Okay? So an interesting parallel there. The most traumatic event in US economic history was, without question, the Great Depression of the 1930s. Now, unemployment peaked at around 25% of the labor force in 1932-33. There's some debate among economic historians about these exact numbers, but the qualitative profile is well known, and I don't think anybody would argue that this was by far the most traumatic economic event in US economic history. The 2008 crisis did not turn into a similar Great Depression, largely due to the actions of the Fed that are still ongoing, trying to support US economic activity. But if you just compare this episode with what's going on, in some of the worst affected countries, here's starting with Ireland, where unemployment has peaked at around 15% of the labor force and is expected to remain at that level through 2018. Okay, that's about comparable. It didn't get as bad as the US unemployment rates at the height of the Great Depression, but it's expected to persist a lot longer. And Ireland is a country with one of the most open labor markets in Western Europe. When things go bad in Ireland, people leave. And even with the massive outflow of people from Ireland, they're still confronted with a 15% unemployment rate. Here's the situation in Portugal, a much higher rate of unemployment and expected to persist again through 2018 at about 20% of the labor force. Here's the situation in Greece. Currently around close to 30% of the unemployment rate, not expected to get much better for at least the next 5 years. And of course, we've all heard the statistics about youth unemployment in Greece being close to 50 or 60%. Not a recipe for social stability, but this neatly illustrates the dire economic pain these countries are going through and helps you put it in a US context. And then Spain, comparably bad situation. So this is a trauma on the scale of the Great Depression that these countries are currently going through. Now, in the United States, as we all know, we had a housing boom and bust that ended really badly. Basically, what happened is that residential investment in the United States went from being about 4% of GDP through 2000 to close to 6% at the peak, and then it crashed to about 2%, and there's a little recovery underway right now. This was what was at the root of our current economic crisis in the US. And we know how difficult it is to get over and work our way through this crisis. Here's what happened in some of the sand states, the worst affected, Nevada, Arizona, Florida. You see, housing construction got to be close to 10% of economic activity in Nevada at the height of the boom. If you go to Las Vegas, you still see the fallout from this boom and bust on the Strip. Here's the situation in Ireland and Spain. At the height of the boom in Ireland, residential construction accounted for 14% of economic activity. People were moving to Ireland to build houses for the people who were moving to Ireland. You think about that for a second. That is not a sustainable setup. That was going to end badly, regardless of what happened with Lehman Brothers, regardless of what happened in the United States, regardless of the Greek default, regardless of Spain or anything. That was going to end badly, and it did end really, really badly for Ireland, as subsequent events showed. So the basic point here is, as the title of this slide shows, the laws of economics grind slowly, but they grind exceedingly fine. I remember when I went to Frankfurt in 1997 to begin work at the European Monetary Institute, I was asked by a number of my new colleagues, what the view in North America was about the likely success of the monetary union, and I sort of pointed out that most North American economists felt that this was doomed to failure because the countries of Western Europe did not constitute what economists call an optimum currency area. It was not a group of countries that was well suited to sharing a single currency the way the United States is. And the implication of that, the interesting retort was, the politicians of Europe have decided that Europe is an optimum currency area, as if that somehow invalidated the laws of economics. And, we know how that turned out. The implication, though, was that living with a one-size-fits-all monetary policy was going to be challenging at best for these countries. And we can illustrate this with a comparison to how things work within the US monetary union. We could ask the hypothetical question of how would individual states in the US conduct monetary policy if they were given the freedom to do so. So what if Texas were to secede from the union and decide to conduct its own monetary policy? Or what if California were to secede from the monetary union and start conducting its own monetary union? Now, these are hypotheticals, so we have to have some kind of a rule as a guide to figure out what would happen in these scenarios. And there's a rule in economics known as the Taylor rule, which is a prescription for how central banks should set interest rates, basically as a function of inflation and output gaps. When inflation is high, you raise interest rates. When the output gap is high, i.e. it's above potential, you raise interest rates. When you're in a depression, you've got a lot of unemployment, you have a large negative output gap, you lower interest rates. That's the basic idea. So here's the data for California. The California output gap, which is in blue, and the inflation rate in California, which is in red. The inflation rate in California is going to be always pretty similar to the US inflation rate, but the output gap can differ because the composition of economic activity in California is somewhat different from the composition of economic activity in the rest of the United States. So you see booms and busts in California. This is the big defense build down in the early 1990s after the Cold War. California went through a major recession as the defense industry contracted. You see then where's the tech boom kicks in. They have a lot of output well above potential, and then here's the current collapse. So what kind of an interest rate would California like to have based on these fundamentals? Here's what the standard rule the Taylor rule would prescribe for California. So interest rates of close to 10% through 1991, then dramatic cuts to below 2% in the wake of the defense build-down, higher interest rates in the 1990s and 2000s during the boom, and negative interest rates in response to the current crisis, which are obviously infeasible, but you'd go to zero. And here's the actual interest rate they had to live with. If we can get this to cooperate. There we go. So there's the actual federal funds rate set by the Fed over this period, okay? So maybe during the 1980s, the actual interest rate set by the Fed for California was not too different from what the Californians would have wanted to have for themselves if they'd had the freedom to choose their own interest rate. But a big divergence during the 1990s and a huge divergence here. Interest rates were way too low by California standards based on what was going on in the California economy at that time. Now, we can do an exercise like this for all 50 states, and we did this calculation. You can cut it a number of different ways. And here's what you would get. So this is the range of interest rates. Again, this is a hypothetical environment in which all 50 states conduct their own monetary policy. They're sovereign nations. They have their own currencies and so on. So you'd have a range of interest rates from maybe 2% to 10% in 1987. And this range, it's bigger or smaller at different points in time, pretty tight in the early part of the past decade. And then this range in the current episode where some states would have wanted negative interest rates in response to the severity of the downturn. Other states would have been quite happy with positive interest rates, the more dynamic, like Texas, for example. We could have probably gotten by with interest rates above the zero level that the Fed has had in place since December 2008. One other thing I'd point out here is, according to these calculations, the actual interest rate set by the Fed between 2002 and the onset of the crisis in 07-08 was too low by the standards of any part of the United States. And this is a critique that our colleague John Taylor has made of Fed policy during this period and how it may have contributed to the building up of these housing price booms that then burst and ended so badly. So John has been a persistent critic and raised this point at many conferences that both Mike and I have been at over the past few years. So here's what happens if we do this exercise then for the euro area. Is it the arrow or the page down? Or
The space bar.
there we go. So this is just doing the same calculation for the euro area, okay? We take each of the 11, we just looked at the 11 original members. But the point to note here is the range is much greater than was the case for the United States, okay? So for some countries back in 1999 at the launch of the euro, 1999, 2001, 2002, 2003, they would have wanted interest rates in excess of 15%. These are countries like Ireland that were growing extremely rapidly at that time. Instead, they had to deal with an ECB rate of maybe 5% or so. These are annual averages, but the qualitative picture is the same. Okay, whereas for other countries that were growing less slowly, the ECB rate was approximately appropriate. The thing to note here, though, is that the rate set by the ECB over the past 15 years has been pretty close to the lower bound of the range that would have been appropriate for the individual countries had they been conducting their own monetary policy. And then, of course, you get this big dispersion in interest rates after the onset of the crisis. Now, at this point, I was going to show you a slide about why the US monetary union works so well by showing you some data on interstate migration. But when I went to the Census Bureau website last week to download the data, this was what I got. Because of the government shutdown, they can no longer provide this data. They actually have it on the computers, but they had to turn off the computers. And not even the logo is showing up. There's a logo supposed to be there, so this is your government shutdown at work.
Thank you for coming today.
But another way we can get a sense of why the US monetary union works and get a sense of the importance of interstate migration as a factor facilitating the working of the monetary union between the 50 states is to just look at the differences in unemployment rates across the US. If people are able to move easily in response to declining opportunities in Michigan and booming opportunities in Texas, then you should not see big differences in unemployment rates between Texas and Michigan because the unemployed people just up and leave. And they are upping and leaving. So when you look at the variation in unemployment rates, it's on the order of 2 percentage points on average most of the time. It gets a bit wider during the crisis, but it is converging again back to the normal levels. Now, arguably, movement during the most recent crisis has been impeded by the fact that many homeowners are underwater on their mortgages, that if you're stuck with negative equity, then it's a bit harder to up and move to a different state in response to job opportunities there when you've lost your job in a state that's still undergoing recession. Here's the comparable figure for Europe. So despite the elimination of all formal barriers to movement within Europe, and this is a major achievement of the European Union, the creation of a single market for labor. If you're a citizen of any of the 27 European Union countries, you can legally go work in any of the others without questions. I think even the transition period for the former Warsaw Pact countries that joined 10 years ago has ended. So you can basically go work wherever you want. So even though you have no legal barriers, there's still other barriers, cultural or whatever, which means that you see this much bigger variation in unemployment rates across the euro area. And then it just blows out in the crisis. And here's Spain and Greece are the guys up here. Germany and Austria are the guys down here. When we were in Germany last year on a business trip, we heard that every German language school in Spain and Greece is fully subscribed. You cannot get into a German language course in these southern European countries. People are actually trying to move. And you got to think that with time, with the emergence of English as the effective lingua franca of business in Western Europe, it's going to become easier over time for people to up and move in response to differential job opportunities. But it's going to take a while to happen. And at the moment, this is one of the key criteria for being an optimum currency area, for being well suited to sharing a common currency that Europe still does not satisfy. So that's just overlaying the two pictures on top of each other. So how do you fix this? Well, a monetary union can exist without a fiscal union. And that was the original design of Maastricht. But you have to have rules to make it work. And they've tried this and it failed. Probably the most important event, the single most important decision was the decision in 2003 by the Germans and the French to throw out the Stability and Growth Pact when it was no longer politically convenient for them. And that just changed the game completely. But in theory, and the architects of the Maastricht Treaty were well aware of these risks, in theory you can make this work. Now arguably, the alternative is some kind of fiscal and political union along US lines. But you're going to have tighter constraints on the ability of member states to run deficits, pooling of regional risks, and especially of banking system risks. So you think of how the US monetary union works. We don't let states run big deficits here. In fact, 49 of the 50 states in the US have constitutional limits, prohibitions on running deficits. But we also have an important pooling of regional risks, and I'll refer you back to the Texas banking crisis of the 1980s. Some of you may remember what happened in Texas in the mid to late 1980s and early 1990s. We had this massive collapse of the banking system. If Texas had had to deal with that crisis on its own without resources from the rest of the United States, that would have been a much more traumatic event for Texas. But instead, we had this pooling of risks. Resources came from California, New York, Florida, and so on, that mitigated the severity of the downturn in Texas and made dealing with that banking crisis a lot easier than it would otherwise have been. Now, I hesitate to talk about lessons from US history in the presence of Mike Bordeaux, but I'll give it a shot. And this is drawn from Thomas Sargent's Nobel lecture last year, where he drew parallels between the situation that existed in the US in the 1780s after independence and the situation confronting Europe today. So there was fiscal crises apparently in several states in the 1780s associated with how they were servicing the debt that the states had individually incurred to fight the Revolutionary War. And the solution was basically to strengthen the powers of the federal government, to go from being governed by the Articles of Confederation to having the US Constitution in place. The deal was the federal government assumed all of the debts of the states at that time, and it also acquired the ability to service those debts. Prior to this deal, we had a bunch of different trade policies. The main way you raised revenue back then was through tariffs. So the federal government acquired the power to levy tariffs on imports, and through these revenues were able to service the war debts. This was sort of a one-time bailout. Okay, it says, we're bailing you out this one time, the federal government takes on all of this debt, and after this you're on your own. And in the 1840s, they did actually allow individual states to default. And arguably, what the Europeans should have done during this crisis was let Greece default. And that may have been one of the biggest strategic errors they made when the crisis first began. Because Greece did eventually default. And all they did was postpone it and shift the burden of the default to different people. Now, if you think of the situation confronting, arguably viewed from an aggregate European level, the fiscal situation is eminently manageable. If you look at the consolidated fiscal accounts of Europe, the situation is not that much worse than the US situation. Now, that may be good or bad, depending on how you view the US situation. But if you just look at the GDP-weighted fiscal balance for peripheral Europe, and that is Italy, Spain, Greece, Portugal, and so on, it's not actually all that different from the US situation. The problem is these states are individually liable for their debts. They're individual situations. They can't sell their stuff as a composite. If you look at the total debt level, arguably they're in a strong, this is net indebtedness relative to GDP, arguably the euro area as a whole is in a much better situation than the US. Now, there's other stuff not being counted here which is potentially very important, having to do with demographic developments, which are potentially very adverse in Europe. So, how do they resolve this? Well, again, many people have said this already, that what you need to do is go to a fiscal union. The problem is, how do you sell that to the electorates? Right? Europe, the vague concept of Europe has become very unpopular in many countries as a result of the austerity programs that are being imposed. And people view this as being something the Germans are forcing us to do, or Brussels is forcing us to do. And that makes selling more Europe, quote unquote, as would be needed for a full fiscal union along US lines, very, very difficult. So there's declining trust in European institutions as a result of the crisis. Many voters have a less favorable image of the EU. But most people still support the single currency. And interestingly, it's in places like Greece and Italy that support for the single currency has remained very, very robust, because many voters in these countries would rather have the Germans running things than their own local politicians. Many surveys have, no, I mean, this is an interesting thing. Many surveys have actually shown this. And, you know, what can I say? So here's the last thing I just want to leave you with. You know, the balance of power, you know, France and Germany are the two drivers, have always been the big engine driving European integration. But Germany looms a lot larger in the overall picture given its economic and sheer population size. It's about 80 million Germans, about 65 million Frenchmen. Well, if you look at the UN projections, in maybe 40 years or so, the relative weights could shift quite dramatic. This, by the way, is why the Germans save so much. They see this coming, and the comment came up earlier on about the Germans not cooperating by spending more. Well, they see this coming down the road, and they know they need to save for their retirement. They're being very prudent and very rational in their approach to some of these issues that have come up over the course of the crisis. So with that, I mean, I think the Eurocrisis is a very nice vindication of economic theory. It's nice to see economics working as predicted, even if it takes 15 years for it eventually to work. The new fiscal compact is potentially a significant improvement over the earlier Stability and Growth Pact, and it just, entered into force this year. It remains to be seen, however, when push comes to shove, whether the government of Germany will take the government of France to court, as this compact allows, if the government of France does not cooperate, or vice versa, and follow the rules. I mean, this is the big unknown. I mean, France has nuclear weapons, right? They can pretty much do what they want, when push comes to shove in these negotiations. So and this was the whole thing. The Stability and Growth Pact was supposedly, an attempt to copper fasten the commitments that were already in the treaty. The treaty already prohibits you from running excessive deficits, and they felt the need to add this additional thing on top of the treaty, and they threw the whole thing out the window when it became politically inconvenient. This is supposed to be a stricter version of it, but given that they didn't, follow the first version, it remains to be seen what will happen with this new revised version. The big challenges: achieving a consensus on new rules and dealing with the loss of sovereignty. Market rigidities, Mike talked about this. I mean, one of the core fundamental problems they have is getting their growth rate up. I mean, that this is a huge problem. They all know, there's a great quote from, I don't know whether it was Juncker or somebody else, all of the politicians of Europe know exactly what needs to be done to make their economies grow faster. The problem is they don't know how to get re-elected after they do what needs to be done. The austerity programs have been very divisive socially. I've heard many accounts from how tragic the situation is in Greece. It is a catastrophic situation on the ground there. And then there's the ongoing potential for social unrest. Seeing as we're coming up on the 100th anniversary of the outbreak of World War I, I have a cryptic bullet point in there about Europe in 1914. In 1914, I don't think any of the major powers in Europe really wanted to go to war. But events were driven by timetables that they felt they could not ignore. And as a result, they ended up in a situation, collectively Europeans ended up in a situation that individually none of them wanted to be in. And that proved catastrophic for the subsequent 3 decades of European history. Now, one can game out scenarios in which this whole thing could play out equally badly. I don't think there's no way it's going to lead to military conflict, but you could see on a scale similar to what happened in the first half of the 20th century. But you could see a situation happening, like a breakup of the Eurozone, that individually no country wants, but because of political and economic dynamics, they end up in this situation because events get ahead of them. And with that, I will stop.
Thank you very much. I'm Marvin Barth. I'm from Covariance Capital, which we found that Megan had come from the furthest. I've actually come from the shortest distance. I live a block that way, and I work a block that way. So I was just stopping on my way back from work. I'd really like to thank Russell personally and the Baker Institute as an institution for inviting me to come here and speak today. This is not only a lot of fun, but also a tremendous honor to speak at the Baker Institute. Really gets many of the world's greatest minds on public policy coming here, and to be included in that list and to be among these panelists is quite an honor indeed. I would also like to thank my panelists, my fellow panelists, for saying everything already and leaving me nothing to say, so I'll just sit down if you don't mind. Actually, I'll take this as an opportunity to sort of play cleanup and sort of summarize everything and pull it back together, which is what I tend to do in my life anyway. So my talk today is going to focus on two sort of interlinked problems. I'm not going to cover the history. That's been covered in great extent. What I want to do is look at going forward. What's the prognosis for Europe? And some of the solutions that I'm going to suggest, I think, are going to be very common. If they haven't been drilled into your head yet, you're probably sleeping or haven't been paying attention. I don't know. But one of them might be a little bit different, I think. Although I think perhaps Michael Bordo might like it and has alluded somewhat to that type of solution. And the other thing that I'd like to do is get people to think about some of the common themes that you've heard about today, which are the importance of institutional frameworks. Ultimately, none of this really will work. The economics are the economics. They need to be guided by an institutional framework. And if you don't have that institutional framework shaping the economic outcomes, ultimately, the economy is like a wave or a tide. It's going to overrun whatever weak institutions are in the way. So you need to build, your tide breaks out of stone, or some sort of other permanent construction. So ultimately, let's get to the problems here. I think the biggest problem is that Europe is just too indebted. And this is another thing that I'd like to emphasize for you all to think about, is that this is not just a problem for Europe. This is a problem globally. So what we watch going on in Europe, we should be taking home as lessons that we as Americans are going to face, that the Japanese are going to face, and ultimately, a topic that hasn't come up a lot today is that the Chinese will face. There's a lot of debt in China. They may be a net creditor to the world, but there's a tremendous amount of domestic debt. Ultimately, coming back to Europe, they just have way too much debt. We talked about the U.S. being in a worse fiscal position. Yeah, that's true if you only look at the U.S. government. But at the end of the day, we produce income, and nationally that's our GDP, and that has to service all our debts, not only our public debts, but also our private debts, all of your mortgages, all of the corporate debt that's out there. all of the small business debt that's out there. This is non-financial debt, so these are the total claims on GDP. There's some netting issues here I'm going to warn you about, but this gets roughly at the picture we want to talk about here. And you can see that Europe has consistently run a more leveraged society than the United States as a whole. Now, this is looking at the euro area collectively. A lot of this is in the periphery, but it is, if we're going to look at Europe as a single entity, which we hope that we will be able to, this is the problem they confront, and that's a lot of debt. So I ran some interesting just sort of thought experiments here, which was, how would you deal with this debt? I mean, the path that we're on right now is that we need to deal with it by growing out of it, and that we need to push back austerity and just deal with getting the European economies growing. And I have to confess that I'm a bit more of Michael Bordo's line of being concerned that growth is not going to be there. But I'm going to go ahead and be wildly optimistic here and assume that the IMF is right. So I've put down their growth projections down here on the bottom. The dark blue is their real GDP growth forecast. The light blue is their inflation forecast. This nominal growth, if we just decided that today Europe is going to stop taking out any more debt. From now on, they're not going to add another penny of debt. And they're just going to refinance their current stock of debt going forward. So in euro terms or dollar terms, the same amount of debt is just going to stay there for the next decade. But their economy is going to grow underneath, right? Okay. Well, in about a decade, they'll get down to U.S. debt levels as a share of GDP, which I wouldn't say is a great goal to aspire to. And this is with pretty optimistic growth assumptions under my part, because I'm not only assuming what I think are relatively optimistic IMF forecasts, which Megan rightly pointed out have not always proven to be so correct. But you can see there's a bump up there 5 years out. The IMF only forecasts 5 years out. So in 5 years, I said, hey, you know what? It's going to be great. They're going to grow at 2%. And they're going to have 2% inflation because, hey, that's what the ECB's target is, right? Or 2% slightly below. So what would be the actual social costs of this, or what would happen to the average man on the street in Brussels or Hamburg or someplace like that? Let's just say that we take this 450% of GDP. Let's just conservatively assume that there's a 2.5% interest rate associated with that, which is actually pretty conservative on an all-in basis across the euro area for corporate debt and for household debt and so forth. Well, that equates to about 11% of GDP. Now, some of that is income that's coming back to European residents because they own a lot of their own debt. But it's still, somebody has to pay 11% of GDP. And this is going to be a drag on economic growth. And if you just take that path that I just showed you and look at, okay, if all our growth is going to go towards paying this debt, and we're not going to take out any new debt, then the growth in disposable income in Europe is only going to grow by about 1% a year for the next decade. That's not fantastic, and I don't think that that's going to create a lot of happiness on the European street if you had growth that slow for that long. But I also think that might be kind of optimistic, particularly for the average person on the street. So let's just look at the U.S. experience to get a comparison here. The U.S. has actually done pretty well over the last 5 years. So if we start when the recession bottomed out officially in June of 2009 through this last June, U.S. debt as a percent of GDP fell somewhat marginally, only fell by 9 percentage points of GDP. Most of that was due to actually defaults on our debt, writing down mortgage debt, and the underlying growth of the economy from underneath. The US grew faster than what we're assuming for Europe. It grew about 2.2% on average over that period. In nominal terms, it grew at almost 4%. And yet, despite all of this, the median family in the United States has seen its income in real terms fall over 1% per year over those 5 years. This is not exactly a positive picture. So what you're seeing in Europe, it's really awful, particularly in places like Greece. You know, some of the stories I hear out there are really terrible. But if this is what they have to look forward to on top of this for the next decade, just to get to debt levels that we're at right now, that's not a particularly encouraging sign. And I wonder about, are the political institutions strong enough to deal with this? And one of the things that has long intrigued me, and Russell may remember this when I was at the U.S. Treasury. One of my jobs was to sort of predict things that could go wrong out there. And I was on the international side, not the domestic side. That's an important caveat. Not that I didn't actually see the other side coming, I just didn't have responsibility for it. But the one of the things that I actually put together as a risk back then was these political problems in Europe associated with exactly this, the data that Mark was just showing about opinion surveys in Europe. And the Europeans have done a wonderful thing. The European Commission has taken these surveys for the past 20, 30 years. What is the Eurobarometer? How far does it go back, Andrea? And they ask the same question over and over every 6 months, and it's amazing. You get this incredible feeling for how people's opinions about institutions have evolved. And what was really troubling to me about Europe's future was that the positive responses plateaued in the mid-2000s, and they never got any better. Now, the negative was increasing. It was increasing from a very small level. It was only like 5% originally, and then it was getting up to like 15%. But the point was, the positives were never getting better. It was always the case, as Mark points out, that the southern European countries love the euro more than their own governments, and that the northern countries love their own governments more than the euro area. But what worried me at the time was the median voter theorem. So there's this great theorem in economics. It doesn't seem like it should be in economics, but actually an economist at UC Berkeley named Ken Arrow won the Nobel Prize in part for coming up with the median voter theorem, which is, it's a pretty simple concept. If you want to be a politician, where do you want to position yourself? You want to position yourself right next to the median voter. That is the person right in the middle, because you want to get all the people to one side of them plus that person, and you win the election, okay? Now, the problem that worried me when I saw this plateauing of support for the euro at roughly 50-55%, if you looked at the euro area as a whole, is that all of those people over here, these are the European heads of state. And for me, this is a figurative, they're figurative for the European elites. All the European elites are on one side of the median voter. Now, fortunately, as Mark points out, that median voter happened to be also on their side by about 10 percentage points. But he's been moving the other direction. And there's a lot of open space, a lot of fertile political ground. And I used to work in Washington, so I love to think about things like this, but there's a lot of political opportunity on the other side of that guy. And there have been a lot of people who've been wanting to take advantage of that. One of the things that makes me lament being an American is when I look at our crisis in Washington today, we don't have anybody like Beppe Grillo, right? I mean, we don't have anybody who's out there screaming, yeah! But we need that kind of passion. But they have that there because they have big issues, and they also have some less savory elements down there below him. That's the Golden Dawn. But you also have in the northern countries, you have a backlash the other way, Alternative for Deutschland. There is the True Finn Party up in Finland. All of these parties are moving the other direction, and they're all grabbing this fertile political ground here on one side of the median voter. And guess what? The economics are pushing the median voter towards towards those groups. That's the problem here. That's the problem with the path of taking, oh, we're going to grow ourselves out of it. We'll slowly get there. It'll be fine. Well, by the time we slowly get there, I'm worried the median voter is going to be over here. That's the thing I worry about. And that gets us to problem number 2, which is that we still don't have a resolution mechanism. Now, I give Andrea complete kudos for pointing out all the incredible things that the European Union has done. If you actually go through the list of the things that he talked about, it's amazing. And you think about the political gridlock we have here in the United States, where we do have a single nation, where we do have a well-established constitution defining things. Could we have achieved all the things that they did? I think we have to give them a tremendous amount of credit. And I also go back to Bob Zellick's comments that you should not underestimate the political commitment across the European Union to this experiment and to making it work. Every time things get bad, they do seem to find a way to make it work. But one of the key elements they're missing is they don't have a resolution mechanism. And you absolutely need this to solve the issues of the banking system, which ultimately feed back to the states and feed back to the sovereign debt problem. So I still am of the mind there are only 2 solutions here. We either have EMU dissolution at some point, or we have to have some sort of fiscal union to back EMU. Now, we can take the strong form of fiscal union, or I'm perfectly happy with a weak form that just gives us a banking union that supports the banks and allows the full faith and credit of the German government to back banks in Spain and so forth. But ultimately, that needs to happen, exactly to Mark's point about what happened here in Texas 30 years ago. The EU has agreed in principle to this, but unfortunately, as Megan was pointing out, there's been a lot of backtracking recently. In fact, at the Eurogroup meeting just 3 weeks ago in Vilnius, the German finance minister, along with the Swedish finance minister and the Dutch finance minister, all got together and said, yeah, we're actually not so sure we like this idea that we're going to be on the hook for Spanish and Portuguese and Italian and Greek bank depositors. Maybe this should really be a problem that should be taken care of at the state level. Well, this is just reinventing the problem that they had in the first place. So that's a real problem. The second is this Cyprus incident that briefly animated markets earlier this year actually set 2 really important long-term precedents that I think are very negative and are going to come back and bite Europe the next time something blows up. The first one is the Germans made very clear, not one more Pfennig. They are not going to put any more money into this. That means, and by the way, Alternative for Deutschland showing in this most recent election is only going to reinforce that political dynamic in Germany. That means that it's going to have to be bail-ins by creditors. Now, personally, I love that idea in general, if we set those up as the rules at the beginning of the game. But we didn't. We're adding that rule later. And so what that means is the next time that we have a crisis in a periphery country, creditors or anybody who owns assets there are going to flee. Capital is going to flee because they're going to be worried they're going to be bailed in. The second thing is, even though Cyprus didn't actually institute its levy on depositors, that flirtation with it created a message to every other depositor in a periphery country, hey, guess what? My deposits might be at risk here. Why not just go ahead and put it in Deutsche Bank or Dresdner Bank or some other bank where a euro is really a euro, not my country's euro? That's a real problem. And I think at some point we may return to this acute crisis. And when this happens, these precedents are going to be very troubling to bureaucrats. So let's go to the solutions. Well, the first solution is we need the banking union. So I'm not going to talk much more about that because I think we've all talked about why that's needed. The second thing is you actually need to use that. I mean, this is one of the great lessons of the S&L crisis. This is one of the great lessons of almost any banking crisis out there. The banking crisis that the banking crises that the Nordic countries faced in the early 1990s is you got to go in and you got to clean out the banks. You got to clean out the bad debts. You got to write them down. This will help with Europe's overall debt problem. It reduces the overall debt burden. It also reinvigorates confidence in the banking system. The banks then begin to lend more. The other thing is you eliminate all these zombie companies. This is a big problem that continues to plague Japan 20 years after its crisis, that there are these companies that are continuing to be lent to that aren't adding economic value because the banks can't afford to let them go. Well, you got to get rid of them and let that capital, free it up to go to companies that are actually innovating and creating growth. And then the ultimate effect of all of this will be that you actually lower effective interest rates, particularly to these small and medium enterprises that George was talking about, because they're now much more creditworthy. There's more confidence in the entire system. So these are the first two things. The last thing I think is a little bit different, and this is something that you don't hear a lot about, but it's that we got to admit, if you go back to this problem I described in terms of, well, let's just try and grow our way out of it, and we'll just sort of go along and keep the high levels of debt. It doesn't work. It's not politically sustainable. We can't do that for 10 more years. It will not work. Before the crisis, I heard a lot of people talk about asset markets in the United States being priced for perfection. In essence, this plan that we have all set out for, and it's not just in Europe, it's in the United States as well, is hoping for perfection in these outcomes. That it's going to be okay if everything works out just according to plan and we don't have any more recessions in the next 10 years and there are no more financial crises in the next 10 years and everything just works out like lollipops and roses, then this is going to work. Okay, great. If you want to take that bet, go ahead. In my business, we don't take bets like that. What you really need to do is deleverage, and deleverage radically. And there's been some great research. I call them the Italians. Andrea probably knows several of them personally. But Alberto Alesina, I know I misspelled Alberto's name, I'm sorry. Exactly. I just noticed that as I was looking up. Francesco Giavazzi and Silvio Ardagna have done some amazing work showing that when you get highly indebted countries, the best path to growth from there is to radically tackle the debt, and in particular tackle it from the spending side. And if you do that, it tends to lead to a sharp contraction, but you bounce back much more quickly. And so you go back to the chart that Michael Bordo showed us about Argentina back in the 1890s. That's exactly the experience that you see with these countries. Now, the only problem with this one is that, as Alesina, Giavazzi, and Ardagna do point out, is that tends to not be undertaken voluntarily. The only country I can think of that has done that voluntarily is, I think, Mark, didn't Ireland in 1976 took that? What? 87, excuse me. So Ireland's one of the few countries that has done that voluntarily. Usually it's ultimately creditors cut you off, and you don't ever want to get to that position where the creditors cut you off. But this is the path that I think we need to follow, and it's not just advice for Europe, it's advice we need to take here at home, in that we need to tackle our debts, we need to deal with them before they become a bigger problem for us. So with that, I'll turn it back over to Russell. I scared them away with talk about cutting spending.
Well, I think we have just about beaten to death the issue of the European Union, and I think that we should be very appreciative of all the panel members that we've heard this afternoon. I think it's just been outstanding. And we'll give them a great big round of applause at the end. We only have about 20 minutes, and so I want to ask a couple of questions of you guys, and then I want to leave some time for you all to ask any questions that you may have. You know, Marvin, you said that one of the biggest problems on your list of problems is that there's too much debt, and I think we probably all agree with that. But it seems to me that the other thing there's too little of is growth. And the real issue, it seems to me, is how do you get the growth rate in these countries up and at the same time deal with some of the other things that we're trying to achieve. The number one thing, you also pointed out, the need to have a strong banking system. In my view, you can't have a successful economy in any country if you don't have a working banking system that people have a lot of confidence in, because banking at the end of the day is a confidence business. And, you know, we're trying to get the banks deleveraged, we're trying to get the banks recapitalized, and we're trying to get their asset quality improved and get them to properly recognize losses where they exist and weaknesses where they exist, which means larger provisions for loan losses, which means lower earnings, which works against their need to raise capital. So the question I have, well, I mean, let me add one other thing to that. I completely agree with you that there needs to be a solution to the resolution problem, as you put it. It's really another way of talking about it is the too big to fail problem. And there is a lot of work going on in that area around the world. Over the weekend at the IMF World Bank meetings, there was a lot of discussion about the alternatives that both the U.S. and the U.K. are proposing. It seems to me that as you try to work out the resolution solution, that first of all you have to have effective supervision. And as we've heard, about 130 of the EU banks next year, by the end of next year, should be under the supervision of the European Central Bank. That will be after they do the asset quality reviews that you've heard talked about today. And the European Central Bank is also, as I understand it, going to oversee the supervision of the remaining banks in all of the other EU countries. So they're not going to be, the bank supervisors in those countries are not going to be out there totally on their own. The second thing that needs to be done in connection with the resolution, it seems to me, is what you called the bail-in issue, which, as most of you know, I think would be transferring liabilities that a failing bank has into equity. I think that if the decision is made, as was done in Cyprus, to bail in depositors, there's no hope left, because as I said, banking is a confidence business, and if you're going to put depositors at risk of having their deposits turned into equity in the event the bank fails, you're going to have a lot of people taking their money out of banks. And that's the reason that we created deposit insurance in this country, was to try to provide some stability to the banking system. So one of the questions that I have for you all is, why isn't one of the things on the to-do list for the EU to create a deposit insurance system, and not one that is funded by the EU, but one that is funded like ours is by the banks themselves? It would take a while to build that up, but why would that not work? And then the final comment I want to make, and I'll be interested in y'all's reaction to it, is that I think in the process of cleaning up the banks, of recognizing their losses, getting them to provision for loan loss reserves appropriately, charging off losses, and increasing capital, I think we have to be awfully careful about how we do that. Because if we try to do it all at once, we're not only going to make the low growth, the already low growth, even lower, in my opinion, but we're not going to be able to reduce the amount of debt that I think everybody agrees is too excessive in these countries. So with that, I would appreciate any comments that the three of you all have on that subject.
I mean, it's a very long, kind of compounded series of questions, but conveniently, let me answer just one part of your thought process here, and this has to do with the deposit insurance. I think there's no capital around by banks to build it up in a way, similar way that we have built it here. And I think the Germans are aware that they they don't want to give additional resources to set up a fund based on which harmonization will take place in terms of the deposit insurance. At the end of the day also, if you think about that, what has happened with the periphery versus the core, all the deposits have moved to where? To more stable countries, especially Germany. So it might be other adverse, indirect incentives based on which even the Germans at this stage might not be willing to put up the funds. So this is my simplified answer. Others might have different opinions.
Well, part of it is a longer-term solution, and I know politicians don't like to operate in the long term, but one way to do it would be the same way that we did it with the FDIC, and that is that it was originally founded with a line of credit from the Treasury, which actually still exists today and has been used once that I can remember. But to the extent that the banks themselves gradually over time could build up the insurance fund, then it would take Germany and anybody else who is participating in that off the hook. So, it just seems to me, I think you're quite right, that you've got to create a system where you don't want people selectively moving from one country to another because of their view of the safety of their deposits.
And also because of asymmetric development. If you move the funds and the deposits, you have different lending, borrowing rates and different growth opportunities. And it appears that in Europe as a whole, if you look Europe as a whole, you might say that they are doing okay, but if you focus attention on the core, you will find out they are doing spectacularly well. So I think this is a reflection of some rigidities and asymmetries that have taken place over a period of time. And responding to your question, yes, practically they can do that with a credit line, etc. The question is, why don't they do that? And it goes back to the previous discussions, because it takes time, I guess, for them to figure it out. Too many people around the table, the different, conflicting objectives might be that.
Well, I was just trying to follow Bob Zellick's admonition that we should look for solutions. Mark, did you have
Well, let me preface my remarks by saying something I should have said earlier, that I speak in purely a personal capacity and not on behalf of the Federal Reserve Bank of Dallas or the Federal Reserve System. Okay, on the reform issue and getting the growth rate up, it is actually possible to do this, and there are two countries that did successfully reform in major ways in the 1960s and 70s, and that's Ireland and the United Kingdom. You're all very familiar with the UK case. But if you think about the factors that led to the major reforms in the United Kingdom, the UK really had to hit rock bottom before there was a consensus for political support for a leader who was willing to undertake the radical reforms that were necessary to take the UK from being what was then known as the sick man of Europe. So you had a political leader who was unique in many ways. She was also extremely lucky. And people forget that. She was headed for a major electoral defeat in the 1982-83 elections. And then the Argentinian government conveniently intervened to shift her popularity. Plus, the opposition party also helped a lot by writing what is often referred to as the longest suicide note in history. So she was lucky as well. And that then enabled her to win a second term and undertake major reforms of the UK economy. But the UK really had to get into a dire situation in the mid-1970s before the people there were willing to elect a leader who was willing to do that. There was a similar situation in Ireland in the 1950s. Basically, population decline, emigration was so severe that people thought this country is actually going to go out of business unless we do something to liberalize and open to foreign investment and foreign trade. And there were a series of major initiatives undertaken in the 1960s to open the economy, to liberalize, that they then built on over the subsequent decades. And then you had the whole Celtic Tiger experience. But you have to have, things have to come together and the politics have to play out in a unique way for these things to happen. And then you have to be lucky. Now, both the Ireland and the United Kingdom also benefited from the fact that they are stable democracies, which unfortunately some of the countries currently in difficult are less stable or do not have as long a history of democratic stability, having had military governments in the relatively recent past. I mean, as recently as 40 or 50 years ago in some cases. So a lot of things have to happen, but it can be done. And I would just mention those two cases as examples.
Oh, that's good. Mark?
You had several different things. One, I'd actually just like to follow up on something Mark said before I address yours, which is it's not so much the democracy issue. So I go back to something that Samuel Huntington wrote back in the late 1960s that it was very controversial at the time, and I think still upsets people. And he pointed out, look, the United States is much more similar to the Soviet Union than it is to a lot of democracies of lesser development. And it all comes down to institutional development. I think the real problems with a country like Greece, and frankly, this is something that worries me actually a lot about a country like Italy, is the institutional robustness is just not there. And that's what worries me. And this is what happened. This is why we're seeing this crisis manifest itself at the supranational level right now, because we haven't built those institutions for Europe. That's the crisis they're facing. So it's not necessarily just about democracy. It's really about the strength of institutions, in my view, and that's just a little sidebar comment. Getting to some of your points, Bob, which I thought were spot on. On the growth versus debt, I absolutely agree. I mean, ultimately, as somebody who used to work for a distressed debt fund, this all comes down to what is the, as George put it, the ratio of debt to EBITDA. How much debt can you fund? Well, the faster you grow, the more debt you can fund. With Europe's demographics, with its institutional rigidities, I don't think we're going to get the growth number to move a lot. And if we are going to undertake the reforms that Mark talks about, these are not things that happen overnight. They take a long time. So it's much easier, I think, for us to actually focus on the growth or on the debt side of the situation and really try and tackle that debt. And that gets directly to some of your points about the resolution mechanism. I mean, you absolutely need to have the ability to go in, shut down banks, write down equity, transfer equity to their senior lenders, support depositors, keep depositors off the table because, as you say, it's a confidence game. That will ultimately help deal with the broader debt problems of the society, but it gets the banks moving again, right? It re-energizes them, gets them ready to lend to small and medium enterprises, and gets confidence back in the system. So to me, that is an absolutely crucial step. And if you look at any crisis, and I think Michael Bordeaux can back me up on it, anytime we've had a banking crisis, it doesn't end until you actually recapitalize the banking sector and make sure it functions again. And then the final point you asked about deposit insurance, ostensibly, Europe does have a 100,000 euro support for depositors. There's just no fund to back it. And that's the ultimate problem here. You point out that in the United States, we have deposit insurance that we charge the banks to fund that. But, as we saw in the most recent banking crisis, that would not have covered it. At the end of the day, you need the full faith and credit of a credible sovereign entity behind it. And that's where the banking union comes in. Greece is not a credible sovereign entity to back its bank deposits. It's questionable whether Spain is, but Europe as a whole definitely is, and that's why they need to pull together and create a banking union that supports a deposit insurance scheme that is inviolable, unlike the flirtations we saw in Cyprus.
Okay, thank you all. Anybody have a question? Lots of questions. Alan?
No, I realize political conditions have changed over the last few years, but I'm wondering what kind of role Turkey maybe plays in relationship to this, because at one time they were very interested in becoming closer, and they do have a growing economy and a large population. Is there any comment you can add about what Turkey's role might be in all of this?
As far as I know, and I can share my anecdotal experiences,
Well,
that
are we going to let the Greek
yeah. No, actually,
take this question?
no. I'm very objective. Let me say that many years ago they were interested in becoming members of the European Union, and a lot of discussions. I think a lot of pushback by the Europeans, and perhaps others can add more. And then they follow a process thereby they will be able to stabilize their economy, develop institutions. Now, immediately after the crisis, however, and whatever happened to Greece, they changed their political tone, and they said, we do whatever we do because we felt that we want to demonstrate to the world that we are an advanced economy, and whether or not we will join the union, it's irrelevant in these states. So, and they have been, geopolitically are very strong in relationships with other countries. The Syria issue, the issues in Africa, the recent, developments in Egypt, all those kind of things. And their access that they have in energy is incredible, given the geopolitical position that they have. So their story has changed from a story we want to get to the European Union, where there were a lot of concerns. Not, by the way, Greece supported them 150%, but they were concerns from Germany and France, namely on reasons I cannot figure it out, but they were socioeconomical issues, freedom of the press, those kind of issues.
And religious.
I'm sorry?
And religious issues.
And religion, freedom of religion and things like that.
Just rejected the application.
Correct. So, but now the story is different, and I don't know what will happen.
Just a related question. Could you make a comment, in addition to Turkey, to the Eastern Partnership? The fact that within the next week, the European Union will have to decide whether they are going to sign free trade agreements with Ukraine in particular, but also with some of the other countries in Eastern Europe.
I'm not familiar with this.
Okay, yes.
Thanks for all the presentations. Going back to the growth versus spending cutting debate, I was wondering how do you build political support for cutting spending to minimize social disruptions, because it makes sense, but it's so hard to advance that politically. And related but somewhat different, could some of the functions, probably varies across countries, become privatized? Some government functions, just like one small example, I read the Royal Mail in the UK became privatized. It got that up recently, and it would vary across countries, but the corporate debt part, the first presentation, I don't know, would some countries be willing to try to take some government functions, make them private, or how can you cut that spending and make it socially acceptable?
That's the black art of politics, right? I mean, economically, I think, as I said earlier, I mean, they all know what they need to do. It's just very, very difficult. You need a great leader to sell this stuff and build a political coalition. I mean, it's ultimately a political as opposed to an economic challenge, selling these unpalatable packages in the promise of payoff down the road. And that's what great politicians do. But, you know, I'm not in that business.
And I would just add to that. I mean, I go back to your point that, you know, for in Ireland and the United Kingdom, they had to hit bottom first. And in most other cases where this path has been taken, it's been because they faced a sudden stop. They've been shut off from capital markets, and that's the only choice that they had left. You got to cut spending.
And this, you know, my opening illustration with Cortes, the Cortes strategy. I mean, in some sense, that's how I always viewed monetary union: is that they were taking one easy option off the table, in the sense that they were, you know, they knew now their hands were tied, and that when the next crisis came along, they could not simply inflate their way out of trouble. Because I mean, that's always an easy option in the short run, but in the long run, it's very costly. Now that option is off the table for these guys, and they're forced to confront these issues head on.
Let's do one more question. Yes, sir.
If there's Armageddon on Thursday, what does this do to the euro and all the stuff we've been talking about here?
So first of all, I will go on record as forecasting we will not have Armageddon on Thursday, regardless of what happens in Washington. First of all, you know, as a political matter, I'm personally pretty convinced Boehner's going to fall on his sword and not let us default. It's a big game of chicken, but ultimately, you know, I don't think they're going to go there. But even if they did, you know, I'm very much in the Warren Buffett camp. I don't know if you guys remember, Warren Buffett wrote a op-ed the last time we had one of these debt ceiling issues, where he pointed out, hey, look, at the end of the day, the U.S. is still going to pay. So I miss a coupon payment. I don't care. Okay? So I wouldn't run out and buy T-bills, because, you know, the T-bills may not pay when they're supposed to. But I would rush out that day and buy every 10-year U.S. Treasury I could possibly get my hands on, because I'll make a lot of money.
Well, thank you all for being here. Russell, thank you for getting this organized, and especially thank our panel. All of it.
Yeah, let me add my personal thanks to everybody who was presenting today. Thank you all for sticking with us throughout the day. Please join us for a glass of wine as a reward for your endurance.